Well, in an unusual move at the moment, US indices fell in overnight trading. But there's nothing to panic about. The falls were very modest, down 0.3%. Various explanations are being given after the fact, but the reality of the situation is that markets rarely go anywhere in a straight line, and the exuberance and optimism we've seen expressed in US markets had to at least pause at some stage, if not correct. And last night we got that pause. There was pressure across the board. Volumes were light. It seemed more like a buyer's strike rather than any aggressive selling. But nonetheless, we did see the markets come off. And futures markets for the Asia-Pacific region indicate that that negative sentiment will flow into trading today. So something to watch out for. One exception today in our region might be the Hang Seng. Despite weakness yesterday at around 1% drop in the Australian share market, the Hang Seng was up 1.4%, and the tech sector surged 2.5%. Now, there are a couple of individual stories that helped that along, but there's very clear catch-up going on in the Hong Kong market. We've been talking for months now about the relative undervaluation of Hong Kong stocks, and given the preponderance of tech shares listed there, it's quite surprising given the fever that many global investors have expressed for US tech shares. And that catch-up, that gap closure in value terms is ongoing and could be one of the key reasons why we saw such a strong outperformance from the Hong Kong market yesterday. Now, I mentioned that the ASX 200 was down almost 1% yesterday. Futures indicating that we'll see an opening fall, and we could see further pressure. And a lot of it has to do with interest rates. But as a trader who's been watching the market for 4 decades, this one's a bit of a head scratcher, because yesterday's monthly data, first of all, is much less influential than the quarterly data that we'll see next month. The quarterly data is what the RBA looks at, but also it's a much more comprehensive survey. The CPI, the monthly CPI, might be called a flash CPI. It's a much smaller sample of goods, and it's much more volatile. One, because it's monthly, and two, because it's a sample rather than a survey. So to see such a market reaction yesterday to this number was quite surprising. What was even more surprising was the market reacted to the headline number. Headline inflation did go up from the previous month from 2.8% to 3%. And that sort of turnaround is concerning, except that we know that the RBA looks at the core inflation rate, not the headline inflation rate. And we knew that the headline rate would go up because the subsidies that state governments have been providing for electricity were removed. So this one should have been expected, and yet the market has reacted quite strongly. Now, I just want to reiterate, the core inflation actually fell down from 2.7 to 2.6%. So this is actually a dovish inflation read, and yet the market reaction was as if it was a hawkish read. In other words, I think the market's got this one wrong. They focused on the headline rate when it should be on the core rate, and it's not a particularly consequential inflation read in Australia anyway. Yet the market is always right, and it certainly reacted. We saw bonds sell off. We've seen expectations of interest rate cuts this year wound right back, and interest rate traders are now only pricing a 50-50 chance of any further rate cuts this year, and 0 chance of a rate cut next week at the RBA meeting. So that's a big shift in thinking about interest rates in Australia. It's no surprise that despite what I think is a flawed logic leading to that sell-off in interest rate markets, that it affected trading in shares as well. And the big fall, the outsized fall we saw here yesterday, indicates that it was about interest rates. And when we drill into the sectors, we see that the worst performers yesterday were those interest rate sensitive banks, capital markets, infrastructure, and real estate investment trusts. They were the worst. All of those subsectors down by more than 1%, most of them down closer to 2% yesterday. So it's very clear it was a shift in interest rate thinking, and we've got a similar situation going on in the US. It's different in that in the US, when we see strong economic data, the market cheers. So we're looking for a stronger GDP read tonight in the US. Expectations are it'll move up above 3% substantially. And yet at the same time, there are expectations of very deep interest rate cuts in the US. Now, both of these can't be right. we can't have strong economic growth and lower interest rates. They work against each other. That would be a recipe for inflation, and the Fed simply won't do it. And yet investors are pricing both a good economic outlook in the US and lower interest rates. And this can't be the situation. These two things are mutually contradictory. And so there's a resolution of this thinking, both here in Australia and in the US, is required. And one of the concerns for investors in the short term is that the market in the US in particular appears to be pricing perfection. They're pricing good economic growth, lower interest rates, and an AI boom that will go on forever, while we've got company CEOs throwing around numbers like $600 billion investments over 10 years. Now, these numbers are not real. And until they start showing up on balance sheets and on bottom lines, investors should be cautious about these expressed intentions, particularly as the numbers appear to shift by the hour. So there's a lot of perfection priced into the market at the moment. To me, that suggests there's very high risk. Now, the momentum up until last night, particularly in the US, has been strongly positive, and momentum is a strong force in markets, but risks are high, and there are contradictions underpinning this current rally that need to be resolved, something investors should be aware of. Moving on to our watch list for today, we're looking at Westpac today. Now, it was slammed as part of that general sell down around interest rates. Its shares dropped 3.2% yesterday. Now, it is up 19% year to date, and banks have been strong performers over the year. But nonetheless, the reaction yesterday was savage. It led the falls in the Big Four and in all big cap stocks. They did announce job cuts of 200. Now, that's not big in a workforce of Westpac's size, and generally job cuts are seen as a positive by the share market, so it looks like this one was discounted. Perhaps some investors were looking for deeper cuts, given what we'd seen at two of the other Big Four banks. And a number of analysts do have an underperform rating on Westpac at the moment, so there's some caution over the outlook as well. So some uncertainty appearing to come into play. And although it was triggered by concerns about interest rates, I suspect that when we see that sort of move in a stock or sector that has risen so strongly over the year, we could well get investors locking in profits and pushing the markets down more than perhaps the underlying cause would suggest. Westpac, one to examine after its big fall yesterday. We also yesterday saw locally the first trading for Washington Soul Pattinson. SOL is now the code again after trading as SOLDA while the merger was being put together. And so now Brickworks and Soul Pattinson have been banged together. It's very clear Soul Pattinson in particular has been an outstanding investor over the years. The track record at Soul Pats has been fantastic. Mr. Milner is a very respected investor, and I think both Soul Pattinson and Brickworks shareholders are likely to be pleased with the structure that has merged out of this deal. A number of analysts have cautiously put hold ratings on the merged entity at this stage. I'd suggest that given the expertise that's involved here, as well as the assets, that might well be a case for investors to be running the ruler over Soul Pattinson right now. The third stock we're looking at today is Alibaba. Its shares rose 9% yesterday. Now, there's already positive momentum in Hong Kong stocks, and particularly in tech-exposed and AI stocks. And Alibaba played into that yesterday with an announcement that it was tying up with NVIDIA in a number of areas, including the cloud computing area, obviously very exposed to AI. Alibaba is looking at AI as a product, B2B and B2C, and that tie-up with NVIDIA, presumably to buy chips, will be very important to their plans. So market clearly very pleased. Alibaba shares have more than doubled this year already. So to see them go up another 9% was an extraordinary performance. They'll be one of the biggest players globally across clouds and chips, and they've committed to spend $50 billion on AI shares. With the shares already at a 4-year high. So we could once again see that momentum continue to push Alibaba and the Hong Kong tech shares higher.